So I recently attended a conference of over 100 investment professionals where one of the presenters posed this question to the group: are rising rates a blessing or a curse? With the Fed having aggressively raised their target rate all year long and bond markets as well as stock markets having a tough year, how would you have answered the question? Well, I'll tell you how the group of pros answered the question in a few minutes. Here's a picture of something we've looked at before. It's the U.S. yield curve for Treasury bonds. And it's looking at two yield curves, the yield curve where it was a year ago, that's the yellow line on the bottom, and the yield curve where it was at the end of last week, the green line at the top. And what you can see is interest rates have risen. Some people are fed up by the fact that interest rates have risen so far as the Fed has been raising rates. The bottom part of the chart, you can see in the blue circle, I've looked at a one-year Treasury, and what you can see there is the interest rate on a one-year Treasury bond has risen to over 4% over the course of the last year. That is an amazing increase in terms of interest rates. Now, how have stock and bond markets reacted to these rising rates, amongst other things? Well, you can see the blue line here represents short-term bonds, and they're down almost 4.5% year to date. That's a big loss for a short-term bond. But if you look at the orange line, down 13.75%, that's the bond market as a whole. That's the biggest calendar year loss for the bond market since the Bloomberg Aggregate Bond Market Index has been kept. Now, we haven't gotten to the end of the full calendar year yet, so we'll have to see if it becomes the worst year on record for bond returns. And then finally, the bottom line represents the U.S. stock market, 22.51. That's bear market territory for the S&P 500. So you'd look at that and say, well, it's hard to see that there's much blessing associated with rising rates. Let's look at this a little bit more here. How would we evaluate whether rising rates are a blessing or a curse? Let's look at two scenarios. In the first scenario, we're just going to assume that, hey, we go back to the beginning of this year, and instead of interest rates rising, they just stay where they were at about 1%. In scenario two, we're going to assume that interest rates just immediately move from 1% to 4%, and we're going to see what happens to the prices of bonds and the value or the return of those bonds over time. We're going to look at bonds that have a duration of 2 years, 5 years, 7 years, and a couple other durations. The idea of duration is, when does the bond actually mature and pay you back the principal so you can reinvest it at the now higher rates? So here we see in year zero, again, scenario one, the rate remains 1%, so the value of that bond portfolio is still $100,000, your beginning investment. But if you look at the 2 year, the 5, the 8, and the 20, you can see that for those bonds with longer maturities, their prices go down dramatically based on the new interest rate environment. That's because if you could have invested in a 4% bond, you're going to pay a lot less to buy that 1% bond in the new interest rate environment. Now, what happens 2 years from now? Well, your 2-year bond, it slowly kind of makes its way to maturity where it pays off at the full value, just like it would have if interest rates would have remained at 1%. So the investor gets back $102,010 total return of their 2-year bond. At that point, the investor can reinvest those proceeds into now a new 2-year bond at 4%. So the rate of return begins to go up in the future at the new higher rate. And you can see that as we extend the chart. Look at the 5-year bond. Same kind of thing happens. It takes 5 years to get back to break even. So your duration gives you the break even point with, have interest rates remained the same or changed, you have to hold the bond to duration to get the break even point. But once you get beyond that break even point, that duration date, and are able to reinvest the funds at the new higher rates, you as the bond holder are better off. You're getting better returns with these new higher rates. And you can see that's true if you look at the 8-year picture. And then if you go all the way out to the 20-year picture, you can see those numbers, particularly in the 2-year duration column and the 5-year duration column. You are significantly ahead at the higher rates than if rates had remained at the same. So by taking a little initial hit to the value of your bond portfolio, if you were patient, continued to invest in bonds, those new higher rates actually were more profitable to you as an investor. So kind of in summary, what does that mean? Well, back to my investment professional friends, when the question was posed, really the answer is something like this. If your time horizon, in other words, the time frame for when you need the money, if that time frame is longer than the duration of the bond, then it's a blessing if rates rise, because you can let that bond run to maturity and reinvest at the new higher rates, and you're going to have more money than rather if rates had remained where they were. But if your time horizon, the time in which you're going to need money from the bond, if it's shorter than the duration of the bond that you're holding, then those rising rates are a curse. Historically, the biggest risks have turned out to be the ones that no one saw coming. The most recent global example, of course, being COVID-19, but the Russia-Ukraine war that started earlier this year is just another example. You know, one way to become more comfortable with uncertainty is to understand the past in ways that can help us form a reasonable view of what we think the future might look like. Not necessarily seeking to make predictions, but seeing the high probability that markets will provide positive returns to patient investors over time. It's especially helpful to see that right now, how the current environment may have created higher expected returns than just 12 months ago. If we look at this chart, what we see is something called the MSCI World Index. It was first constituted in January of 1970, and it just, in this chart, tracks the growth of a dollar that would have been invested at the inception of the index through the middle of 2022. And what you can see about that green line is the growth has been pretty good. As a matter of fact, the average annual return has been better than 9.4% over this period. The other thing, though, that you'll notice on this chart is there's been plenty of stress along the way, plenty of negative surprises. There's always a degree of uncertainty that investors have to accept. But to the patient investor, at least in this time frame, if you held the investment the entire time, you're rewarded for bearing that stress. There was an opportunity for investing in the midst of uncertainty. Look at that a different way. This looks at the U.S. stock market returns. And what we're doing here is saying, well, how long do you plan on investing in the stock market? How long do you plan on being invested? On the far left, that big blue bar represents a 1-year range of return. So if you said, I'm going to put my money in the stock market, but I'm only going to leave it there for 1 year, what do you think might happen? Well, the range of returns historically since World War II has been as low as losing 43% or as high as making 61% over a 12-month period. Now, if you go out to the 10-year period, what you see the worst case scenario now, if you agree to hold the stock market for 10 years, your worst case scenario would have been about 3.5% negative. If you go to 15 years, you're no longer looking at a negative worst case scenario, at least historically. All along the way, the average annual return has been better than 10%, but the range of returns, the degree of risk that you're taking, you feel like it's going down the longer that you hold the portfolio because it narrows the range of potential outcomes. So what does that mean? Well, let's think about this the same way we looked at that bond market duration. For stocks, if we're talking about stress or opportunity, well, it depends. Again, if your time horizon is greater than 10 years, it seems like the stock market provides opportunity. But if your time horizon as a stock market investor is less than 10 years, well, it provides some reasons for stress. You know, it can be said, and this has been said lots of times, patience is a virtue in many things. And certainly for investors, patience is a virtue. To get the long-term returns associated with stocks and to do so with maybe manageable levels of stress, you need to be patient. You need to be a long-term investor. On the bond side of the street, if you want to get positive returns, you need to match that duration with your time horizon so that your time horizon is always just a little bit longer than the duration or the maturity of the bonds that are being held. If that's the case, the way that we looked at it is you would expect to be better off even if interest rates are rising. The uncomfortable truth for all of us as investors is that some uncertainty is always present. At times it just seems more apparent than others. At that same investment conference that I was at a week or so ago, I heard David Booth say, uncertainty creates stress and opportunity. We're going to be fortunate to be hosting David along with former Senator Bill Bradley, and we're going to have a conversation about the kinds of uncertainty that are in the world today and how people can make a game plan to deal with that uncertainty, whether it's applied to markets, political life, or world events. We hope you'll be able to attend. We're going to have a live event here in West Des Moines, as well as a live stream option for people to attend in Omaha. If you want to register for the event, please go to our website, www.fostergrp.com/events to register, and we hope to see you there. Thanks.